Okay, this is going to be a short video about retracements because it seems like a lot of people freak out when markets retrace. So this is a 5-minute chart on the ES right now. So the market, I had mentioned before that, once it breaks these balance areas, and then here it created another little balance area, then you can start to short this market. Market's going to go down, and then it came back up, went down, and then it went back up. So people freak out because they bought here, and the market went down. They shorted here. They bought put options. The market went down, and they were making some money, and then it started coming back up to here. Now they're back at either break even or a little bit minus. Then they came back down. Now they're back making money again, and then they came back here and not so much money. So what's the story behind this? So you have to remember the 5 laws. So markets go up, markets go down, markets go sideways, balance areas, markets trend, and markets retrace. So what does that mean? Okay, markets go up and down. That's what they're doing. Right now it's trending down. Markets balance. It's in this balance area. Create another little balance area here. And there's another little balance area. So it's always creating these balance areas. So markets go down, they go up, they go down, and these ups and downs are retracements. So those are the 5 laws of the markets. That's what they always do. They're irrefutable laws. You can't deny them. They're going to do that. And the reason they do that is because you have buyers, you have sellers going down, you have buyers going up, and that's how this is only about making money. You have buyers here, sellers here, buyers here, sellers here. And that's how you make money. So it has to go like this, up and down, in order to make money. It can't be one straight line down forever or one straight line up forever. Okay, so let's look at a 30-minute chart. So a 30-minute chart, it doesn't look all that scary because the market came down, balanced out in here, now it broke down, and it's still broken down. It's not so high, so it may not look so scary to you as opposed to this 5-minute chart, because this looks pretty scary. It came here, it looked like it was going to go back up, came down here, it looks like it was going to go back up. But if you look at a 30-minute chart, not so much. It looks like it's building this little balance area right in here, and it looks like it's still in the downtrend. Now if you look at a 1-hour chart, same thing. Looks like it's building, but it's starting to come down. You got lower lows here. Now you look at a 4-minute chart or 4-hour chart, and same thing. It looks like this market's still breaking down. Yeah, it came up here because it came all the way down here, and now it's retracing. Like I said before, markets will retrace anywhere in between these 2 lines, which here's a 50% line, here's a 38, and here's a 61. So usually retraces in here about 90% of the time. It'll retrace. So this market came from here, it went up to there, and now it's retracing and it bounced off this 38. So this is all normal right here. But when you start looking at a 5-minute chart, you start freaking out. Why? Because you bought somewhere in here, came down here, you're happy, it's making money, and now you're not so happy. Comes down here, you're happy, now you're not so happy. So you have to look at different charts. Even if you're a day trader and this is a 5-minute chart, you can feel relieved if you look at a 30-minute chart. And you can even day trade these 30-minute charts if you want to. Some people look at the 1-minute charts and the 5-minute charts, and they're just all over the place emotionally. So you got to be careful with that. You can even day trade a 30-minute chart. Like I said, if you wanted to day trade, what I call an insurance plan is you buy options, let's say put options going down. You believe this market is going to continue in this downtrend. You can buy put options going down, but you buy them far enough out, as far as, let's say, a month out. And when the market comes down, and let's say it does decide to come back up into this area, and it's not going to turn around till several days later, then you can stay in your trade. So you can convert that day trade into a longer term trade, into a swing trade. If you still want a day trade and a market came down here and you decided, okay, I just collected my $200 or $2,000 and I'm getting out and you're done for the rest of the day, you can do that. So you have an option, you have a choice. But if you buy options that are going to expire in one day, you don't have any choice. You have to make sure this market is going to go down, and you're going to make some money on it, because you can't afford for it to come down and bounce up and then stay in this area and then tomorrow come down, because you have to sell out today. Okay, so another factor here is time. Right now it's 10:45 a.m. Pacific Standard Time, and this market's about halfway done here. You know, it's usually trades for about 6 hours, a little more than 6 hours a day. And if this market were to come all the way down, let's say the market started here, and let's say eventually it comes down to this point, but it takes several hours. Now, if it were to come down here in like 30 minutes, and it's already made its full extension on the ES, this is the ES, is usually 60, 80, 100 points at max. It'll go beyond that, but that's pretty far. That, you know, once it goes that far, it's pretty much done. And if this were to do a 100-point range in 30 minutes, now you've got, what, another 5.5 hours trading? Where's this market going to go? It's going to come back up, because that's what this is. It's a buy-sell game. So you're going to have a bunch of sellers. You know, you're going to have the buyers stepping in. So now it's going to have to come back up. So it's good that it's doing this right here, breaking out of this balance area, creating another balance area, coming down, creating another balance area. Balance areas are good. We want that. That makes the market really healthy going up, as opposed to just a straight shot up or a straight shot down. Okay, so this video is pretty much about not freaking out and just understanding the 5 laws. Like I mentioned before, markets go up, markets go down, markets go sideways, balance areas, markets trend, and markets retrace. Every market does that. Every market. So like I said, I'm going to reiterate here. If you bought here and it went down here and then it came back up here, you're freaked out because, you know, you're either minus or about even. Then it came down here and now you're plus. Then it came back up here and you've lost that gain here, and then you're freaking out again for, you know, the second time, and now the market goes down. So just to clear that up, if you want to look at a 30-minute chart, you can say, okay, this is normal. It's just built this balance area here. And like I said, balance areas aren't 100%. What I mean by that is that they'll break above it and they'll break below it, but as long as they're within these certain parameters right here, normally, you know, if you get a bunch of hits up and a bunch of hits down that stay within these parameters, then that's good. Then that's a balance area right there, as opposed to something that's kind of crazy, like maybe this is a little bit crazy because it went down. Maybe that's not a good example, but some of these are not really that accurate. Like this is not really, I mean, this is a part of a larger balance area, but it's starting to break down and then a pop back up. So it's not too accurate right here. And sometimes you get that. You know, that's why you gotta, I would trade balance areas that are pretty clear. Like this one's clear. This one's pretty clear right here. This one's pretty clear. And then when you get clear balance areas, then you know when they do break out that they are going to travel in that direction. Now here's the key. How far do you want it to go for you to collect your profit? Some people wait too long, and then a market comes around, turns around because it goes up, because this is an uptrend. Okay, now if this uptrend is done and now it's a downtrend, then you can probably be pretty safe going down. But you don't want to get too greedy. If you buy options here and you trade and you sell them here, you can make $200. So how can you make more money? Well, you can wait till it comes down then you make more money. Or the $200 you just made, you can add positions. So the 200 turns into 400 and you're still trading that same range. Or that 400 can turn to 800 if you buy even more positions, and so on. It can go all the way to, you can make $2,000 in this trade and then just walk away, or buy it, wait till it gets down here and make $2,000. It's different ways of trading that. So when you start buying here and it goes down here and you just take this short range, it's called scalping. And scalping could be really good because it's almost guaranteed the market's going to do that. It's going to travel, let's say, 10 points on the ES. And if it does, like I said, you can make 200, you can make 400, you can make 1,600, you can make 2,500. It just, all you do is you just keep adding to your position as opposed to just waiting for it to finally come down here. You can do that too. And you could sell here, like I said, wait till it bounced around and it broke down and then buy again here and then make another 10 points or another 2,500 or $200. Simple, right? Just like I said, you follow those 5 laws: balance areas, markets go down, markets come up, and markets retrace. That's what they do. There's this one, market retraced to here. Market came down here and it retraced. They're always retracing. Market comes up, it retraced. So those are the 5 laws. Okay, so that's the end of this video. Just to tell you, don't freak out when you start seeing these markets coming back and you look at your account and it starts to fluctuate and you think you're going to lose money. You can switch to a different chart. You know, instead of a 5-minute chart, which could be kind of freaky in here, you could go into a 30-minute chart and say, okay, it doesn't look so bad anymore, right? Because it's doing its normal thing. Okay, that's it. Talk to you later.